Ever wondered how to grow your wealth while you sleep? It's a question that has puzzled many ever since money became the medium of trade. The quest for financial freedom and sustainable income, especially in our sleep, has led many to explore various investment strategies. From real estate, bonds, stocks, forex trading, to cryptocurrencies, the myriad of options can be overwhelming. Each has its own merits and demerits, but one strategy stands out in terms of simplicity and effectiveness: dividend investing. Dividend investing is a method that has been practiced and proven over centuries. It is a process that involves buying shares in a company and, in turn, receiving a portion of the company's profits on a regular basis. These profits, or dividends, are what you earn as a shareholder. Over time, these dividends accumulate, thereby creating a steady stream of income. This is particularly beneficial because it assures you of earnings even when the market is down. In contrast to other investment strategies that primarily depend on capital appreciation, dividend investing provides a safety net during tumultuous times. Imagine this: your investment portfolio is still bringing in income even during a bear market. Moreover, dividends are often reinvested to buy more shares, leading to compound interest. This means your wealth doesn't just grow, but it expands at an increasing rate. The concept of compounding, Albert Einstein once said, is the eighth wonder of the world. This makes dividend investing not only a method to earn a steady income, but a powerful tool for wealth multiplication. Yes, the answer to growing your wealth while you sleep might indeed be simpler than you think: dividend investing. It's a method that allows you to earn a steady income from your investments even when the market is down. Dividend investing involves buying shares in companies that pay dividends. This process is more than just a simple transaction. It's a strategic move, a calculated decision that investors make when they choose where to place their money. Dividends are essentially a portion of a company's earnings that is distributed to its shareholders. This isn't a random act, but a deliberate one, carefully executed by the company. The distribution of dividends can be likened to a periodic gift to the shareholders, a token of appreciation for believing in the company and investing in its future. These dividends are handed out typically on a regular basis, providing a steady stream of income for the shareholders. It's this consistency that often draws investors to dividend investing. Investors can choose to reinvest these dividends, buying more shares, and thereby increasing their stake in the company. This can lead to a powerful compounding effect, leading to growth over time. Many investors see dividends as a safety net, a cushion against the volatile nature of the stock market. They provide a certain degree of stability and predictability, which is often comforting in the dynamic and sometimes uncertain world of investing. So imagine this: it's like having a money tree in your backyard, only this tree is planted in the fertile soil of the stock market. It's a tree that not only grows, but also bears fruit regularly, providing you with a reliable source of income. It's this metaphorical tree that embodies the essence of dividend investing. The first step in dividend investing is choosing the right companies. It's a crucial foundation upon which successful dividend investing is built. Your goal is to identify businesses that have demonstrated a certain level of financial stability over time. This stability is often reflected in their ability to consistently generate strong earnings, even in fluctuating market conditions. At the heart of this strategy is a focus on companies with a proven track record of maintaining consistent dividend payouts. These dividend payments are your reward as an investor. They offer you a return on your investment even when the market is. Think of them as your financial safety net, providing a steady source of income in both good times and bad. To find these companies, cast your eyes towards mature, established sectors. Industries like utilities, consumer goods, and healthcare are often home to businesses with the traits you're seeking. These sectors may not be filled with the most glamorous or headline-grabbing stocks. However, they are the ones can offer a certain level of predictability and reliability, key features for dividend investors. These businesses may not be the most exciting stocks in terms of rapid growth or volatility. However, they possess a sturdy, dependable nature that makes them ideally suited for dividend investing. They may not set your portfolio alight with drastic price increases, but they're the ones that can provide a steady stream of income. First and foremost, consider the dividend yield. This essentially concerns the annual dividend payment as a proportion of the stock's prevailing market price. Put it simply, it's the ratio of the annual dividend payment to the stock's existing price. Just imagine, when you're investing your hard-earned dollars into stocks, this is one of the key figures you would want to understand and monitor. A higher yield may potentially lead to a more satisfactory return on your investment, allowing gain more from the money you put in. However, it's crucial that you don't just chase after the figures blindly. The allure of a high yield can be quite seductive, but it's pivotal to remember that all that glitters is not gold. Be cautious of yields that seem to be sky high. These can often be red flags, hinting at potential issues within the company. They might be an indication that the company is going through some financial turbulence or potentially facing bankruptcy. Remember, just as high profits can seem enticing, higher risks often accompany them. The truth of the matter is, these unnaturally high yields may be a desperate move by the company to attract investors, and the dividend, in reality, may not be sustainable. But beware of extremely high yields. They might be a sign that the company is in trouble and the dividend may not be sustainable. Once you've selected your stocks, you're ready for the next crucial step, the actual purchase. This process might seem daunting at first, but fret not. You'll be using what is known as a brokerage account. This account is essentially your gateway to the world of stock trading, providing you with the tools and resources you need to buy and sell shares effectively. A brokerage account is a specialized account designed to allow investors like you to buy stocks, bonds, mutual funds, and other types of investments. It works much like a bank account, but instead of storing money, it holds your investments. These accounts can be opened with various online brokerages or through traditional banks that offer such services. To purchase shares through a brokerage account, you need to first fund the account. Once the account is funded, you are free to start purchasing the shares of the companies that you have selected. During this process, it is important to remember the golden rule of investing: buy low and sell high. However, we must stress that investing in stocks isn't about immediate gratification, it's a long game. You've chosen these stocks because you're confident about their long-term prospects, right? So don't get caught up in the day-to-day price fluctuations that are a normal part of the stock market's function. Instead, focus on your long-term goals. Stay patient and disciplined. Investing is a marathon, not a sprint. Remember, the goal is to hold these stocks long-term, so don't get caught up in daily price fluctuations. Be steadfast in your patience and let your investments grow over time. After buying, it's important to monitor your investments. This step is fundamental to ensure that your financial resources are being used effectively and that your portfolio is continuously growing to reach your financial goals. The process of monitoring your investments is not merely a one-time event, it is a constant activity, a recurring duty that demands your time, energy, and attention. To effectively monitor your investments, it's essential to keep an eye on the company's performance. This includes looking at its financial reports, operations strategies, market share, and competitiveness. It means analyzing the company's revenues, net income, earnings per share, and other financial indicators. But it also means understanding the industry in which the company operates, including trends, challenges, and opportunities. Additionally, monitoring the overall health of the dividend is equally important. Dividends are a significant source of income for many investors. They represent a portion of a company's earnings that is paid out to shareholders. Therefore, if a company's dividend seems at risk, it could greatly impact your expected returns. To evaluate a dividend's health, consider its payout ratio, its consistency, and its growth over time. However, as crucial as it is to monitor your investments and stay informed, it's also vital to know when to take action. If the company starts to struggle or the dividend seems at risk, it might be time to sell. Always remember, the goal of investing is not just about making money, but also about protecting your capital from unnecessary risks. Reinvesting your dividends is another key step. This is an essential part of your investment journey, and it cannot be stressed enough. Picture this: you are at a crossroads where on one side you can take the cash payout in your hand and leave, and on the other, you reinvest those dividends back into the market and buy more shares. It might seem tempting to take the instant gratification of cash in hand, but let's delve deeper into what reinvestment can actually do for you. Think of it this way: reinvesting your dividends is like rolling a snowball down a hill. As the snowball rolls, it picks up more snow, growing in size. This is essentially what happens when you choose to reinvest your dividends. Those dividends are used to purchase additional shares, which in turn generate their own dividends. Reinvestment is like a cycle that continues to revolve and grow, building upon itself. It's like a tree sprouting branches and leaves, each new leaf representing a new share bought with the dividends. Over time, this tree grows taller and spreads its roots. Similarly, your investment portfolio expands and becomes more robust. The reason why this works so effectively is because of a beautiful phenomenon known as compounding. Albert Einstein once called compounding the eighth wonder of the world. He who understands it, earns it, and he who doesn't, pays it. What compounding does is it allows your investment to grow exponentially. Each time you reinvest your dividends, the size of your investment increases, and hence the dividends you earn also increase. Just like the snowball that grows larger with every roll, your investment too expands with each reinvestment. This allows your investment to grow even faster, thanks to the power of compounding. So, reinvestment is not just about increasing your shares, but also about leveraging the magic of compounding to speed up the growth of your investments. Let's go over the key details of dividend investing. Commence by picking established firms known for frequent dividend distributions. These are typically identified in areas such as utilities, consumer goods, and health. After that, take into account the dividend yield. A more significant yield could indicate a superior return, yet exceptionally high yields may imply potential issues. Maintain a buy and hold approach. Ignore day-to-day price changes. Your primary objective is to generate long-term income. Keep track of your investments. If you notice an underperforming company or a threatened dividend, it may be time to consider selling. In conclusion, a crucial strategy is to reinvest your dividends. This practice amplifies your investment growth utilizing the principle of compounding. In conclusion, dividend investing is a strategy that can provide a steady income and help grow your wealth over time. It's a powerful tool that should be considered by anyone interested in long-term investment. Not only does it offer a consistent source of income, but also has the potential to generate considerable wealth through the principle of compounding. Moreover, the dividends you earn can be reinvested to buy more shares, which in turn can produce more dividends. A virtuous cycle of wealth creation. Nevertheless, it's crucial to understand that investing is not devoid of risks. Like any investment strategy, it is subject to market volatility and the overall economic climate. Hence, it becomes crucial to have a meticulous stock selection process and conduct ongoing monitoring of your portfolio. Investors must evaluate a company's profitability, its ability to generate regular dividends, and its future growth prospects. Expert advice and detailed research can also be beneficial in managing these risks efficiently. The beauty of dividend investing lies in its simplicity and potential to harness the power of compounding. Over even small dividends can grow to a large sum of money, making it an ideal option for those interested in building a secure financial future. So why not plant that money tree today?